I'd like to welcome everyone today. This is Matthew Ike from U.S. Energy Development Corporation. On with us in our expert speaker series, we have Dan Steffens. Many of us in the space, not just U.S. Energy, are fond of how he looks at the market and the level of technical expertise that he brings to the market. So Dan is the founder of Energy Perspectives Group based in Houston, Texas. It has over 200 members, primarily the high net worth individuals investing in the energy sector. He publishes a monthly newsletter with 200 profiles each year on publicly traded energy companies. I would recommend any and all to sign up and follow him. I find his perspective on the market to be unique and educational. And although we're bringing you Dan today, hopefully you continue on listening to his sage advice for time to come. So with that, Dan, I will transition the rest of this call until Q&A to you.
All right, thank you. Okay, oil market update. Let's get right into it. I want to look at where we are in this current oil price cycle and why oil prices should rebound quickly once we get into this post-pandemic period, which thank God it appears that we're headed into it with the vaccines. I got a few oil price forecasts. I actually got a very optimistic one just today from Goldman Sachs. I'll show you that. Current active drilling rig count. You know, how many rigs does it take just to keep U.S. production flat and to get us back to growth? And where are we in the rig count now? And where do we need to go to? And what's it going to take? What price is going to take to get us there? And then I'm going to talk for a little bit about the Green New Deal. A lot of our members are worried about, you know, Joe Biden becoming president and adopting this Green New Deal, and they believe that could really hurt oil demand. I don't think so, but I'll try to show you why. Okay, so here we are. As of today, oil closed today at 45.53. Now, if I would have told you that about 6 weeks ago, you would have said, Dan, you're an idiot, because here we are on October 30th. We were down at under $35 and way below the trading range. It had been trapped in a trading range of 38.50 to 41.50 for about 3 or 4 months. And, you know, the day traders that move a lot of the oil price in paper, they love these kind of things, because once it gets up here to the top, then they just, you know, they short it and they wait till it gets to the bottom, then they go long, and, oh, they're making, you know, $4 or $5 a barrel every month and can make a lot of money doing that. But what caused the price to go up 32% since the end of October? And that's number one by far. Probably 90% of it is COVID-19 vaccine optimism, and they should be optimistic, because now we have 3 companies that say they have vaccines that work. And I saw the one on Pfizer today. They said even with the first dose, it is works very well. When you get the second dose, you're probably 95% safe from then on. Anyway, but we got to get people to take it, I guess. But they are making the vaccine very quickly now. So oil demand does exceed production today. That's something that a lot of people don't really understand. We are draining inventories, and I'll show you that, some tables. OPEC Plus continues to do their job. So OPEC Plus is the OPEC cartel plus Russia and a few handful of companies that are pretty insignificant, but it's really Saudi Arabia and Russia, and they're keeping the group kind of in line and cutting back on their production to, you know, gradually bring more production online and, you know, just gradually raise prices is their goal. But it's to their benefit to do it, because they all survive on oil revenues. And then lack of capex, capital expenditures and investment, is going to cause U.S. and non-OPEC production to fall even more. U.S. production is down 2 million barrels a day. Non-OPEC production total is probably down about 4 million barrels a day, and probably will go down to a total of about 6 million barrels a day, decline from where it was at the beginning of this year. So another thing, global population just keeps growing. The world's population going to increase by over 80 million people this year. It's actually been a relatively low amount of deaths this year compared to a normal year. Maybe all this washing of hands and mask is done thing, but you know, all the hype of the COVID-19 deaths is you know, way below normal. Each year, about 0.8% of the population at the beginning of the year dies during the year, which makes sense. We don't live to over 100. So more people equal more demand for energy, and that energy comes from oil. So here we are back to 45. So what's the right price? So let's look at a longer chart. This is a 10-year West Texas intermediate price chart. And for about 4.5 years in the early part of this 10-year cycle, we were in, you know, this is wonderland for the oil companies. We were stuck between $80, $110 barrel range. And everybody was making a lot of money, and this is when the shale production was really picking up. And then there's really been three separate cycles, and I'll show you. The first one was started when Saudi Arabia decided to gain market share, and that happened late in 2014, and that took the price way down. They thought they could destroy the shale players. They did not, and it really hurt them more than anybody. Saudi Arabia lost over $100 billion out of their sovereign wealth fund. But then they doubled down and they took it down again. So we've had two double bottoms. Everybody thought this was the first place it was going to stop, which was right below 50. It bounced back to 60 real quick, but then it went all the way down to 30. But then we had a pretty steady increase, hung around here at 50 for a while, and then went all the way up to 65 to 75. I know this, people, I don't remember 75. Well, that was just in 2018. We had $75 oil for a while. And then what happened? Then a new oil price cycle started, and the second one was the U.S. versus China trade war. That's what started this big drop when we started slapping tariffs on each other, and all these ups and downs. One of these spikes, I think, was when Iran did that missile attack on Saudi Arabia. But all this other stuff up and down was, headline driven by trade war stuff. Trump, a new tariff, and China responds with something. But anyway, this last spike right here, which was at the very end of 2019, we went to $65 when the phase one trade agreement was signed. And I can tell you at that point, all the upstream companies that I follow thought we were headed for 75 or 80. They thought, okay, now we got it. Now global demand is going to pick up and we're going to be up here. Well, then the pandemic started. So this is the third wave. And the pandemic caused the biggest decline in demand for oil-based products ever because of all the travel restrictions. That took it down all the way to $10. I know some of you heard that oil went negative. That was just in the futures market. Some day traders, paper traders went negative, and some lost a lot of money. But in the real world, it just went below 10, but then quickly bounced back to that where I was showing that range, 38 to 42 range in here. And then recently, this $5 pop was because of the pandemic vaccines and the hope that it was going to end. So here's an oil price forecast. Now, this is Raymond James' official oil price forecast that comes out at the beginning of every quarter. So they published this on October the 5th. And at this point, this forecast was based on a viable vaccine not happening until the second quarter, about in here. They thought at this, they had 6 or 8 months before we'd see a viable vaccine, and they thought that would take, then we'd see $50 oil by the end of the second quarter. Well, so you can push everything, all of these up one quarter. So instead of $40, now we're probably looking at an average, because we were, low for a while, of 42 here. Then I bet this goes to 48, 60 will move over, 70 will move over. And by then, if we get $70 oil, you will see a significant uptick in drilling operations, and it'll probably stabilize. And I believe, and so does Raymond James believe, that the right price for oil is $65 a barrel. Now, so I looked for some more forecasts, more recent. Well, the one thing I found, and you can Google these guys, there's a website called the Economy Forecast Agency. It's based somewhere in Europe, I think London, and they do these surveys of economists, and they now believe that the closing price for oil of West Texas Intermediate, they have Brent's about $3 higher than this, WTI will close at the end of December of 53. And I could tell you, if this happens, there's going to be a lot of upstream company stocks that are going to go through the roof, and a lot of drilling deals are going to look a lot better. And they're predicting $60 oil by the end of February. Now, these are probably made on mathematical formulas, and because of a big move like this, they think the trend's going to just continue. But then today, I got this article, and the head guy, Goldman Sachs global head of commodities research. So you can imagine this guy is a pretty highly paid guy. He spoke today, and he said that we're going to see, this is probably Brent, an oil price of $65 a barrel by the end of 2021. So a year from now, $65 oil. And I'll tell you, a lot of oil companies will be very happy with that, because they've cut costs. Their drilling costs are way down. And they're going to be at $65 oil. They're probably making what they used to make at $100 oil back in the early part of the decade. But anyway, good to know. Just one forecast. But when Goldman Sachs speaks, it usually draws a lot of attention. And this just came out today. This is as of December the 8th. I just got this about an hour and a half ago when I was preparing this slide presentation. Anyway, so this is what they're looking at. Here we are at, you know, the end of the year. We're right here, and every year about midway through the first quarter, you start to get a big spike in demand. And the spike in demand comes because the refiners have to build inventory of raw material. Crude oil is their raw material for the manufacture of the gasoline and diesel and the other fuels that we use, the other products we use that make us have a great standard of living. And they believe, and I believe too, that we're going to get global demand. Global demand was 101 million barrels a day back in the second half of 2019. Actually, for a few days, got to 102 million barrels a day. And then we had the huge drop from the pandemic, but it bounced back pretty quick. I mean, you know, everything shut down real quick, but then, you know, traffic and truck traffic bounced back pretty quick. And so this kind of V-shaped recovery, but now we're headed back. But remember, supply and demand were pretty tight back in here. So we were using 101 million barrels a day, but we were barely producing 101 million barrels a day. So we're dropping about 4 or 5 million barrels a day out of non-OPEC production. So we're already down here. So if it gets down into here, but eventually we're going to need every barrel of production that OPEC can put out. So if this keeps going, it's not going to be long before we need all that excess OPEC production. So here's U.S. This is actual U.S. production as reported by the states. And the most recent we have for actual production is the month of September, which just came out on the first day of December. We found that out. But here's what happened. So we're exactly 2 million. So U.S. production peaked at 12,860,000 barrels a day, and we're at 10,860. So exactly 2 million barrels a day. But this big drop at first, when we had the big drop from March to there, was because there was fear that the U.S. storage facilities were going to fill up, and the storage facilities, midstream companies, pipeline companies told the upstream producers that they were not going to be able to take their oil, and they forced companies to shut in a bunch of production. So then this happened. Well, then, you know, it didn't fill up. The tanks didn't overflow, and some of the shut-ins started coming back online. And then we had a pretty active hurricane season in the Gulf of Mexico, which shut in, you know, 500,000 to 1 million barrels a day a few weeks. So a lot of this is just shut-ins. This growth is just shut-ins coming back online. So it's, you know, I get notes, well, look, U.S. oil production's growing again. It's going to grow. I said, no, these are just shut-ins coming back online, and it's not really the base. The base production has actually declined about 1.5 to 2 million barrels a day for sure. So what happens if you don't drill wells and you don't complete wells? Oil production goes down just because all wells go on decline shortly after they're placed on production. So back, remember when we had $75 oil, our rig count, active drilling rig count, got up to 1,100 active rigs in 2018. So see this gray here, that's the price of oil. So the price of oil drives capital spending and got the rig count way up. But then we had a price drop. Remember that, you know, this is the trade war drop here. And so then that rolled over and started coming down, and then the pandemic one, and this was the big drop. So we're way down here. We only have, as of last Friday, 246 rigs drilling for oil and 75 drilling for natural gas. So in my opinion, just to hold production flat in the U.S., we need 600 rigs drilling for oil and 150 rigs drilling for gas. Some people think this is 500. I've seen it as low as 450 because they think they'll high grade the drilling and drill the best locations first. That may be true, but if you know, we need to get back to 500 rigs, and we're at half the number of rigs that we need just to stabilize production. So again, back in here, this is when we thought that the storage was going to fill up, and it did get way above the 5-year average. Just gray is the 5-year average. But U.S. oil storage capacity is actually, if you filled every available tank, about 640 million barrels. But working capacity is this top line of 580. You always want to have some, you know, empty capacity. So the working max is about 580, and we never really got close to that. So there was no danger of tanks overflowing. And believe me, that will never happen because all the storage facilities are managed by people that know they can't let that happen. So they will just, you know, yell on the phone to shut in production and make it happen. So we're down here. We're now back. This is reality now. So we're back to the top of the 5-year average, and we're headed toward a period where inventory does need to grow, where it always grows in the first quarter because refiners need feedstock for the refineries to make gasoline and diesel. Again, this is a 2-year chart, so this red arrow goes back 1 year. So this is where we were a year ago. This is where we are today. So it's not, it's higher than it should be, but it's not a glut. So now this is probably the most important slide I'll show you. OECD inventories, days of consumption is the primary driver of liquids prices. It drives diesel prices, gasoline prices, which in turn drive up oil prices. Now, remember when we looked and there was a period of, okay, the chart is the bars are the actual inventory. This blue line is the price of oil, and it's an inverted price. So the price of oil goes up at the bottom of the chart. So as the inventories come down below the line, the refineries want to keep about 30 days of supply. So this red line is 30 days of supply. So we had this long extended period of declining inventory. And once it got down to just 29, just 1 day below, we're looking down here at $100 oil. So you go over here and you're at $100 oil. And then it started coming back up. Well, this is when, the upstream companies were producing a lot more oil for one thing, and then here Saudi Arabia decided around in here to flood the market. And when this went up, oil prices went down to 40. But then again, as we headed into 2018, you fell below that red line, and here you got back to $75 oil right here. So here we are today. Now the forecast is, because we're draining supply now, demand exceeds the production, exceeds the oil coming out of the ground. So the delta has to come out of storage. And it won't take till we're down here, because if this starts cascading like this, when we're in like this line here is the third quarter, when we go below this red line, that's going to draw a lot of attention. And I believe that's when we're going to see a big spike. This is why the spike to $65 oil by the end of the year makes sense, because if this happens in reality, because this cannot happen. This will not happen, because if it does, you will see, if you get even to 25 or 26 days of supply, we'll see oil prices go triple digits really quick, and that will stimulate a lot of production, and it will shut off a lot of demand just because we'll start rationing by price. So again, here's to show you that we are in a deficit period here. This blue line is demand, and the yellow line is production. So we had this big period where demand was below production, so storage got high. But now we're in a long extended period where demand exceeds production, so that's draining storage. And actually, when we get out here to the middle of 22, we are going to need OPEC to put all their production online by the middle of 2022. So we're only about 18, 20 months away from needing all of their oil. And the last time we needed all of their oil, that's when we had $150 oil price. So anyway, so we'll leave that. And I do think my belief is that we will see $60 to $65 oil in the second half of next year. So now I want to talk about the Green New Deal, because I know a lot of people are worried about this. For one thing, it's not going to happen just because it's way too expensive. The price tag on the Green New Deal is $40 trillion. Now, I don't know about you, but if we fund a $40 million expansion program, there won't be any retirement money left. They're gonna steal everybody's money to do this. So this will send inflation through the roof, and we just literally cannot afford it. But another thing to remember, and I say after 20 years, but really, wind and solar have been around for 30 or 40 years, and they only produce about 3% of our total energy. So what's, these projections that we can get wind and solar to produce all of our energy, all of our electricity, to wipe out, take out coal-fired plants and all the gas-fired plants. We don't burn oil to make electricity, by the way, so these are no danger to oil. But to do that would a massive construction thing. It would just be unbelievable. And the other thing is, we need electricity all the time, and the wind doesn't blow and the sun doesn't shine all the time, so you're going to have backup plants anyway. But I will tell you that if any region of the country goes to 20% wind and solar, they are going to have rolling brownouts. They're going to have regular power outages, and no economy, not the state level, not the country level, can stand to have this, because this is the problems that you have in India and most of the world, is they do not have regular power. We are so blessed to have regular electricity and regular, affordable, abundant natural gas. And if we do something to do this, we're really headed down the path to a bad economic situation. But anyway, then there's just the environmental issues. Everybody thinks it's all green. It's green because we call it the Green New Deal. It must be green. Well, to come up with the materials for all the wind and solar facilities, we're going to have a 2,000% increase in mining, and it's going to destroy the environment. Mining is a very energy intensive. Those trucks that have the tires that are 3 times taller than a human and 50 feet high, they get about 1/10 of a mile to a gallon. It's a very, very energy intensive process and will actually increase demand for oil. Wind and solar the wind and solar themselves create a massive waste problem, because eventually they wear out and you're going to have to dispose of all that stuff. And the windmill blades, I know, are a big problem. And it just will not work. One oil well produces more energy than hundreds of windmills. Think about that. One oil well that produces an average of 500 barrels a day produces more than 100 windmills. So it just doesn't pay out. So about 100 million barrels per day of demand cannot be replaced by wind and solar. They make electricity, so they're not going to make enough for all the energy demand for all the EVs or whatever we'd have to have. But let me just end on this. Why the Green New Deal won't really work. It's just simple physics. You know that Tesla battery factory that's out in Utah? It would have to take 500 years for them to make enough batteries to store the electricity that the U.S. uses in one day. Let that sink in. That stack of batteries would go around the moon and all the way back, and it would take them 500 years. We're going to have rechargeable batteries. We're going to need them. We're going to have electric cars. There's no doubt about it. But to totally replace our power grid is impossible.